All right, I'm going to try and do this one video once so I never ever have to speak about this ever again. So if you are sitting there confused by the doom and gloom boomers that are out here, the $1,000 net worthers and the $10 a month DCA gang and the happy hippies that are out here talking all this shit about this upcoming spot Bitcoin ETF, I'm going to do my best to clarify every point of doom and gloom that I've heard regarding this ETF right now in this video. So you need to pay attention to this. You also need to subscribe to the channel because, again, there's all this misinformation going on. There's all these people talking about, oh, just because it's a cash create, it means that the ETF doesn't have to hold spot Bitcoin. Fucking morons. This is why this YouTube channel is important. This is why I decided to do this, because all of this needs to be clarified, because otherwise people are going to be left behind. So please subscribe, please share the video, and yeah, help me spank the YouTube algorithm to getting Bitcoin content out in front of more people. Now, let's go over a little bit of the doom and gloom that's been going on regarding these ETFs. The background is this. An ETF works with two functions, well, three functions in fact, right? I'm going to separate them out for you to make it really easy. And I also want to point out that the best person to learn about ETFs from, especially the Bitcoin ETF, is James and Eric from Bloomberg Intelligence. Follow them on Twitter. They're the people that you should learn from. I'm going to do my best as not an ETF lawyer, as not an ETF analyst, as an investor with a little bit of experience to break down exactly how this is going to work from my perspective. But those are the guys that you should follow and should listen to. Now, as far as there's three functions, three parts, three processes that an ETF has to go through. We're going to separate this out to make it easy for the slow people that haven't really understood exactly how this works. Step number one is the part where the cash enters the ETF, right? The point of an ETF, if we're getting down to the basics of it, the point of an ETF is to allow, in essence, ownership of an asset through an entity that controls the asset. So, for example, if I have a warehouse and that warehouse is owned by a company, and that warehouse is filled with coffee bags, right? And now that's the only asset of the company is coffee bags. That's it, right? And I give you the opportunity to be a shareholder in that company. In essence, the value of your shares of that company are basically the value of the coffee in that company. That's what an ETF is, right? So you're not directly owning the coffee, but you don't need to warehouse it, you don't need to look after it, you don't need to do anything. All you're doing is owning the shares, and I'm going to take care of the coffee for you, and you're going to get an increase in value based on how much the value of that coffee goes up by. That is an ETF, right? It's nothing more complicated than that. So there's three parts to this, three processes, three steps that I want you to imagine. Step number one, and these are not the three rules to Bitcoin. This is the three processes of an ETF. So we'll call it process number one. Is when you as an investor are going to inject capital into that ETF, right? That is called the creation part. Okay. Process number two is the storage of the asset within that ETF, right? That is the basic functions of the ETF. And process number three is when you want to redeem or extract capital or withdraw capital from that ETF. That is the redemption process. Now, a lot of doom and gloom boomers have been around talking about how, not understanding the difference between a cash creates and an in-kind and all this other shit, right? It's very, very simple. A cash creation process works like this. You give me cash to acquire some coffee. I then use the listed, authorized coffee sourcers that we have, that you will see in the prospectus, right? I will tell you, we're only going to buy coffee from XYZ people. I will go send the cash to them. They will give me the coffee and they will put it into the warehouse, right? So that's a cash creation, because as you have given me cash, I have created the asset with the cash. But the flip side of it is in kind. What does that mean? What that means is if you have a bag of coffee sitting in your house, you can just ship me that bag of coffee and I'll put it in the warehouse. And I can flip you some shares because of the coffee that you've sent me at the reference value of the US dollars value of that bag of coffee. So that is the difference between cash creates and in kind. When you are doing process number one and you are injecting capital into an ETF, there is a two-step, you have to pick one process. And what's going on right now with the Bitcoin ETF is the SEC is insisting on cash creates, whereas some of the ETF providers are insisting on in-kind. And here's the reason for that, why they would want to do it differently. Because if you are a big institutional investor and you want to exchange your Bitcoin for ETF shares, which might sound absolutely crazy to the $1,000 net worthers, but happens every single day to the tune of billions of dollars for ETFs because of the legal soundness and the structure and the regulatory oversight of these products. If you want to do that and you have a cash creates ETF, what you have to do is you have to sell your Bitcoin, right, that you own. You then convert it into cash and then you send the cash to the ETF, and then the ETF creates that Bitcoin within the fund. This is obviously a problem because if I own a bunch of Bitcoin and I want to put it into the ETF, then I need to sell it. And when I sell it, I generate a tax liability. Okay? So therefore, ETFs generally for commodity style products, which is what Bitcoin is, want to be an in-kind solution. So I can just send you the Bitcoin and you put it into the ETF and exchange me some shares for it, and there's no taxable event that happens there. That's why some people are saying that it has to be in kind, and some people are saying we'll stick to cash creates. So, process number two. This is in process number one, let's look at the amount of manipulation that can happen here. There can be some manipulation in the price of a cash creates ETF. Where might that happen? That might happen when, for example, let's say I send the ETF cash on a Friday afternoon, right? I send them cash on a Friday afternoon. How do I send them cash, by the way? I buy the shares, right? As I buy the shares, it generates liquidity. Then that ETF sends the liquidity to its authorized parties, and then those authorized parties will go and acquire the Bitcoin and put it into the ETF. Between the process of Friday and Monday, when they start buying the Bitcoin, that could be a moment where you could have some slippage or some manipulation that happens in the market price of Bitcoin, which is why they always allow for some synthetic representation in order to maintain the price. This is obviously going to differ from ETF to ETF, and each prospectus will be different in explaining how they're going to do this. But this is not anything serious. This happens every day, day in, day out, with every ETF product out there that is a cash creates ETF product. If you think this is the first time in American history that they are creating a cash creates ETF, you're a moron. Right? Now, can we say that we prefer an in-kind ETF? For sure. Right? Of course, it's much more simple and much more tax efficient. However, this is not a big problem. This is not as big of a problem as needs to be discussed the way it's being discussed by people on Twitter that are never even going to be buying the damn ETF. You got people telling me about the ETF and wondering whether they're going to actually hold real Bitcoin, which I'll get to in a second. And these people are never even going to own the ETF. And you're worried about this. Instead of getting to one Bitcoin, you're focused on bullshit again. Right? This difference between cash creates and in-kind only matters to you if you want to exchange your real Bitcoin that you hold in cold storage for ETF shares. That's it. If you don't have that and you want to play around with the ETF and you want to buy a few $1,000s of ETF stock, none of this is going to make an absolute flying fuck of a difference to you. So this whole conversation is completely irrelevant, but people are having it, so I'm here to explain it to you. Process number 2 is the actual ownership of the Bitcoin. And for some reason, some doom and gloom boomers out there seem to think that because an ETF is a cash creates ETF, it won't be holding actual spot Bitcoin within the ETF. This is complete bullshit. The ETF prospectus, on which it is regulated by multiple entities at the exact same time, with oversight up the wazoo, means that the Bitcoin will be held in the ETF. The point of the ETF is to hold Bitcoin. The cash creates part is the process number 1. How is the cash being injected into the ETF? But once it's in the ETF, the thing's got to hold physical. The thing's got to hold Bitcoin, right? The thing has to hold Bitcoin. It has to be audited, and it has to be regulatory. You know, it needs regulatory oversight, which is why there's so much of these conversations going on. And if you think that someone is going to take the risk of not holding physical Bitcoin in an ETF, which has such a transparent structure when it comes to the amount of people, scrutinizing it, you just don't understand how financial markets work, and you're probably never going to use the product in the first place. So there's no point you thinking about it. This is straight up doom and gloom boomerang right here when it comes to, ETF might not hold any Bitcoin. I mean, I don't even know what to say. It's such a stupid comment, right? It's such a stupid comment and a lack of understanding of what these products are, what ETF products are, especially when you've got the biggest asset managers in the world. Yeah, maybe you'll have a little bit of fraud from small asset managers that just spring up ETFs in the future. But you think Fidelity is going to do that? You think BlackRock's going to do that? Come on. What are we talking about here? So that's process number 2. It's actually holding the Bitcoin. It will, whether it's cash creates, in kind, whatever, because that's process number 1 that we're talking about. The middle part, process number 2, actually holding the Bitcoin, it will be held in the ETF. They will have to buy the Bitcoin. Whether you do a cash creates process number 1 or an in-kind process number 1, the Bitcoin will be in the ETF, and that will be audited, and that will have oversight. So process number 3 is when you as a shareholder want to withdraw your capital, i.e. the redemption process. And what's happened here is that the SEC has insisted that they want a cash redemption process for the ETF, for the Bitcoin ETF. What does that mean exactly? Because you can have a cash creates process and a cash redemption process. You can have an in-kind creation process and an in-kind redemption process. Let's explain how this works. So it's basically the exact flip opposite of process number 1. If you have a cash redemption process and you decide to sell your shares, you would go and sell your shares in the market. The ETF provider and the authorized parties will then sell in an appropriate amount of Bitcoin to reflect the amount of cash that has been raised by selling the stock. That is a cash redemption process. You will receive cash when you say, I want to sell my stock. The in-kind redemption process is this. You could say, I have $1 million worth of, whatever the symbol is, Bitcoin ETF. And I want to sell that $1 million, but I want Bitcoin for it. So then you would go to the ETF provider, fill in a form, go through the bureaucracy of all of that, and they would basically extract the Bitcoin, send the Bitcoin to you, and remove the shares from your account upon receipt of the Bitcoin. So now you have had an in-kind redemption process. If anything, this is more inefficient than actually just selling it. Now, the tax argument we can discuss, but without the tax argument, when you've got an asset that's so liquid, it's probably faster for you if you really need to sell your Bitcoin now and convert it into actual Bitcoin that you can possess. It's probably going to be faster for you to sell the ETF shares in the market, take that cash. Who has the nerve to disturb me while I'm recording a video? Anyway, you take that, you sell the shares into the market, you raise that cash, extract the cash out of your broker account, send it to a Bitcoin exchange, buy the Bitcoin, and then put it into cold storage. That process is typically going to be faster than trying to go through the bureaucracy of an in-kind redemption process. Now, when it comes to taxes, depending on what your tax structure is, the in-kind redemption process is obviously going to be better for flowing Bitcoin in and out of the fund. But in-kind is more relevant for assets that have a slower volatility element to it and have less liquid markets, like gold, where you might want the actual physical gold extracted from the ETF. And even with GLD, you need a $1.5 million. So if you're not thinking about buying $1.5 million worth of the Bitcoin ETF, you don't even need to think about this. It's completely and utterly irrelevant to you. And by the way, I want to make very clear, the supreme best way to own Bitcoin is going to be you control it in cold storage. The ETF is going to be options for people who have regulatory oversight, for people who want to raise financing on their Bitcoin, etc., etc. It's going to be for sophisticated investors. For the majority of people, you follow the 3 rules of Bitcoin, and that's that. Right? You hold the Bitcoin in cold storage, in custody, and you don't need to worry about the ETF. The difference here is that whatever happens in the ETF is going to benefit you, because the price of your Bitcoin is going to go up. Not normally, you can swing around that with other ETFs, like real estate ETFs, right? You can swing around that, right? If people have made a lot of money in Miami, BlackRock goes and raises a REIT, which is a real estate ETF, basically, in LA, for example, and dumps the money into LA. Now, if you're in Miami, you're fucked. That doesn't happen with Bitcoin. With Bitcoin, the Bitcoin ETF can come out, all of the money can go into it. You don't ever have to even think about the Bitcoin ETF, but because you own Bitcoin, the value of your Bitcoin is going to go up because it is a monetary network. So again, there's 3 steps to the ETF process. There is the creation process, which is the injection of capital. There is the middle process, which is the storing of the Bitcoin. And then there is the third process, which is the extraction or the withdrawal of the capital, or the redemption of the capital. So creation, storage, redemption. That is the 3-step process of an ETF, and that is what is being debated right now, and what is being demanded by the SEC is a flow-through cash creation process. They want you to create shares and hold the Bitcoin with cash, and they want you to extract capital with cash, not with Bitcoin. And here's why they want to do that, or at least what I think is going on. There is so much manipulation in the Bitcoin space that they want control over where the Bitcoin is bought. They don't want any Bitcoin ending up in an American ETF that might be linked to terrorist financing, that might be linked to criminal activity, etc., etc. So what are they doing? They are not relying on the end institute or the end investor, you and I, basically, to check whether that Bitcoin has a history of being tainted or not, right? We can argue that one Bitcoin is one Bitcoin, but the SEC doesn't see it like that. What the SEC is saying is we much prefer the investors putting cash into the ETF, and then the authorized parties using the fear of regulatory oversight, making sure through their systems that the Bitcoin is clean and it's then bought fresh. It's like this. Imagine if I had a cookie jar, and the cookie jar was the ETF, and there was a bunch of beautiful cookies in there, and you wanted to put one of your cookies in there, and you said, "Hey, I want to take part in this cookie jar. I want a piece of the cookies." Cool. What do you think is better? If I've spent years maintaining the quality of these cookies in this cookie jar, what do you think is better? That I just let you take your grubby cookie from wherever you've put it, and I don't know, it might be the best, but I don't know that, right? And just open the jar lid and throw the cookie in there and let it infest the rest of the cookies? Or do I say, give me $2, I'll go buy the cookies or make them in the same way that I've been making all these cookies and looking after them, and put them in there to maintain the quality of the cookie jar? That's what the SEC is trying to do. I have no problem with a cash create or a cash redeem Bitcoin ETF. Eventually we will see an in-kind ETF, because here's the truth. These companies have the ability to do the research on the incoming Bitcoin, because as soon as you give them your wallet, they'll be able to find out everything that they need to know regarding where the Bitcoin is coming from, who it's been touched by, etc., etc. So, and someone like BlackRock, Fidelity is not going to take the risk of going and getting Bitcoin from illicit sources or whatever, because they just have too much regulatory oversight and it's not worth sacrificing the reputation of their business. However, the SEC is trying to be as strict as possible, and part of the reason is they just got an ass whooping by the courts, so they need a win. And part of that win is going to be, this is a cash create, cash redeem, Bitcoin ETF, spot Bitcoin ETF, super secure, completely regulated, etc., etc. That is the win that the SEC is going for, and that's the win that I believe that they will get. And how do I know they're going to get it? Because BlackRock bent the knee. If BlackRock is going to bend the knee and say, we'll do cash create, cash redeem, it's game over, right? At this point, you should not be worrying about, what's going on here. At this point, you should be panicking to get to 1 Bitcoin before this thing gets approved on Jan 8th, 9th, and 10th, according to the Bloomberg intelligence guys. I don't know how many times this has to be said. Anyone who's telling you that there is going to be, that these ETFs are not going to hold Bitcoin, etc., etc., I don't even know what to say. And I'm seeing prominent people say this. It's I don't know. I don't know where it's coming from. I don't know why it's coming, and there's certainly going to be competition. I'm surprised that exchanges that sell Bitcoin haven't spoken negatively about the Bitcoin ETF. I think that they just know that they shouldn't, so that otherwise they get railroaded. When I was in the gold space, I was telling people to use GLD instead of buying spot physical gold, because then you can generate a cash flow on your GLD position using derivatives. And the gold miners hated it. Anyone who sold physical gold was an enemy of mine, because I was actually killing their business plan. And that's exactly what's going to happen here. The ETF is going to come out and murder any exchanges that are selling Bitcoin if they haven't got good backing, right? Coinbase is going to be buying up these exchanges for pennies on the dollar at this point. And I said this months ago, the worst thing to invest in is going to be a Bitcoin exchange, at least a boutique style Bitcoin exchange. But anyway, the point here is that the ETF is a solid structure. It's been proven in American regulatory markets. It is the oversight is beyond what you can imagine. The debates that are happening right now are absolutely normal, but they're normal for the final stages. They're not normal for the beginning stages. You're not having an in-kind versus cash creation and redemption conversation if you're just kicking the tires on this thing. This is done. This is done, and it is coming. And the one thing that you need to focus on here is actually getting to your 1 Bitcoin and not getting distracted by these BS conversations, right? If you think that institutional investors give a shit whether they get a cash creation, a cash redemption, or an in-kind creation, or an in-kind redemption ETF, you're behind the 8 ball. You're behind the 8 ball. And no one is going to go to another jurisdiction like El Salvador to put multi-billions of dollars just because you can get an in-kind redemption when they've got all of their tax set up in the USA. The US capital markets are the single most important in the world. They are 40 times bigger than Europe. And that's why this ETF is extremely relevant. And guess what? Time is running out. Which is why I want you to subscribe to this video, subscribe to the channel, share the video, because this conversation has to end while you are focused on cash creates, in-kind. Oh my God, what's happening here, this, that, and the other. You're getting distracted again. The goal here is to get to 1 Bitcoin, because for most people watching this, the objective should be to own your Bitcoin and control it yourself. The ETF is going to be for mainly institutional investors and short-term speculators that just want to get into the market. For everyone else, the best way is actually owning the damn Bitcoin yourself, because you can actually do that for the first time in human history and benefit from the ETF with the capital going in there. This ETF is going to extract so much capital out of other markets and other investments, and it's going to take things to the next level. And if you're sitting there worried about what the fuck is going to happen, are we going to have a cash creates or an in-kind, when you're not even a candidate to use the product that you're talking about, it is a complete and utter waste of time. So take my word and follow the 3 rules of Bitcoin, of which there are still only 3 rules of Bitcoin. Step number 1, you buy Bitcoin. Step number 2, you shut the fuck up. And step number 3, you get fabulously wealthy.